Next in radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. The date is July 19th, 2016. And, hey, it is that silly season known as political convention time. But perhaps something interesting did happen yesterday. No, I'm not talking about plagiarized speeches, demonstrations, although not too many. But Danielle Park is with us now. It's been a while, Danielle. How are you?
Hey, good. I'm great. The summer's going too fast as always, Kerry, but that's a function of being over 50, isn't it? Time just whips by.
Yeah, well, I just had my eyes done, so I feel like I'm under 50 now.
Awesome. So you're saying I need a bit of plastic surgery? Is that what you're saying?
No, I didn't know you were over 50, so it's news to me. But, hey, Trump calls for the reimposition of Glass-Steagall. And you and I, we've been talking about this for a long time. And if you're not familiar with Glass-Steagall, Depression-era law that was passed as a result of, what was the name of that commission again?
Oh, the Cora Commission.
Cora Commission, which separated commercial banking from investment banking. But the reason why, there are a lot of reasons, but because we had the FDIC, didn't want government insuring gambling, the casino aspects of investment banking. And so during the Clinton administration, Rubin and who was the other gentleman's name that we all love to hate?
There's so many, Kerry.
Larry Summers. Right.
Yes.
So they got together and said, it's outdated. We don't need it anymore. Bankers will behave themselves. You can trust banks to do the right thing, of course, right, Danielle? You can always trust banks to do the right thing.
Which just was a glaring indictment of their wisdom and ability to understand the human animal. They think with their head, but they don't appreciate that there's this pattern of behavior that's gone on since time began, and that is the very reason that we need some hard returns in the divisions between these departments and types of firms. Because as soon as you have a sales firm stepping in as an advisor, you have a problem. And that is a plight of the entire free world today. And the only way for us to correct some of this horrific imbalance that has taken us all down the bad path to financial ruin, frankly, in the world is to sever that, to separate that hat of advisor from the sales side. And the more entrenched you are in the status quo, the more you insist that's impossible. And yet I believe it's exactly the impossible that must be accomplished if we're to make any meaningful progress.
Yeah, well, look, we've seen it with these derivatives, with Bank of America shifting their entire derivative portfolio into their insured banking operations, effectively putting the American taxpayer on the hook for their derivatives portfolio. This commercial banking was never designed to be an exciting go-go sector. It was like, simple matter. You put your money on deposit with the bank, and then they make business loans. That was the purpose of it, to enable businesses, worthy businesses, in quotes, to be able to fuel their expansion and to be able to finance their operations. And
worthy in that sense just strictly means credit worthy. It means it's not a they didn't have a sort of a bias against certain kinds of businesses. In the traditional banking model, it was if you had the ability, character, capacity to repay the money with interest, that was a good bet, and banks were prepared to make it. And it was all about managing your own risk. And then it was the commingling and the amalgamations that went on in the late 80s that were spearheaded by Citigroup, and it really chipped away at all those divisions and convinced everyone. And Mr. Greenspan at the helm of the FOMC was a huge proponent of allowing this notion of the mosh pit of finance to just everyone all in together, which again was a terrible example of his lack of foresight and understanding. So anyway, that's the mess that was made. Now, interestingly, last night at the convention, at the Republican convention, Trump drops that he intends to bring in Glass-Steagall. Now, I'm a little suspicious because his other comment had to do with unwinding Dodd-Frank. Now, there's some good things that have been accomplished with Dodd-Frank. It didn't go all the way because it lacked this critical division piece. In fact, the complexity of Dodd-Frank was in large part fueled by this unwillingness to incorporate that one significant break between the advising and selling side. And because that wasn't there, they sort of dressed it all up, window dressing with complexity, which was unfortunate. But there's still a few things about getting the derivatives market into the light of day, about having a much more transparent, having more on open markets as opposed to over the counter. There was a bunch of stuff on succession planning, how banks will be broken up if they get into financial trouble, the pecking order of who eats what losses, and starting from the equity holders all the way through the bond holders before you get anywhere near customer deposits, higher capital ratios. A lot of those things are also products of the Dodd-Frank Act. So, if we were to just toss all that out, I think that would be going backwards as well. So I think we need all of these things. I think it's very strategic. I think that Trump brought up this clearly because he sees it as a critical piece in the assault against Hillary Clinton. Because Bill Clinton was the president in '99 who signed the bill to repeal Glass-Steagall, I think this is an obvious way to attack the Clintons in saying you want to bring back Glass-Steagall. So all that strategy I'm fine with if that makes sense. I think that Clinton is clearly seen as the Wall Street candidate. Now, interestingly, I see the short list still includes apparently Elizabeth Warren as her VP. And I think that from a strategy perspective, although there's all this talk about big banks saying they won't support Clinton if she does make Elizabeth Warren her VP, the fact is that may be something she needs to do in this chess game with Donald Trump now, because they both have to appear it seems like with the public mood and the finances of the world in shreds, they have to look as though they're anti-big banks and that they're going to push back and get these institutions back off the public purse. So it's interesting, to the extent that Bernie Sanders expanded that conversation all the way through the primaries, I think that was a valuable contribution from his part. And now we'll see, how, I think if Hillary doesn't put a very clearly negative banking person on her ticket, then she risks losing all of the people who would have voted for Bernie Sanders had he been the candidate. And, just basically alienated a lot of people who think that this revamping of the finance sector is absolutely foundational. And I think it is too.
Yeah, well, I agree with you there. I don't know how she puts the toothpaste back in the tube, considering she got $20 million to make 15-minute speeches to Goldman Sachs et al. About how wonderful job they're doing. To paraphrase Lloyd Blankfein, doing God's work. I don't know how you spin that, but Dodd-Frank just has so much wrong with it and has had the opposite effect of giving the banks more power, consolidating them. There's a lot less banks because the smaller banks, the cost of compliance has gone up so much. This Consumer Financial Protection Bureau is a joke. It's not done any good, and it won't stop the next financial crisis from occurring. So, the whole thing.
But that's a bit of a cop-out, Kerry, because it is a multifaceted front that must be advanced in this regard. And it has to do with behavior and self-control and institutional controls across a whole myriad of things here. I think it's a little bit naive or simplistic to say that if one regulatory body or one act or one aspect of it doesn't control the whole thing and prevent a financial crisis, then, it's of no value. I think it's all these pieces together because it is a very complex organism. Pushing towards simplicity is the way to go. And I'd be all for editing down Dodd-Frank or cherry picking out parts of it, whatever is necessary. But certainly this push for reform has to start with the foundational divisions that need to be put back in place.
Yeah, absolutely. I'm just saying that the effect of it has been to like consolidate the banks and wind up doing exactly the opposite of what needs to be done. And the Consumer Financial Protection Bureau, everything that they've been charged with doing, all these other regulatory bureaus, agencies already were charged with that responsibility. So adding another bureau on top of all the other garbage in the long run isn't really going to solve anything, and in fact has made it worse. Less mortgages being made, more hurdles being put up, and the other thing is redefining the purpose of the banking sector. Do we really want more consumer lending? Okay, that's like the last thing we need here. Okay.
Yeah, absolutely.
More credit card securitization, more home lending. All right. Yes, the home sector is important, but flexibility there. Okay, with taking the government out of the equation, Fannie, Freddie. Let's get rid of them. If it means higher rates, then we need to have higher rates. Okay,
I agree.
Because we need. You're the one who's always saying return to risk-based pricing. As long as the government's in it, we're never going to have it, and get them out of it. Okay.
Today, so Goldman Sachs released its second quarter earnings today, and they beat on earnings just because they did a bunch of antics and a bunch of cost cuts and a bunch of bringing back in provisions they'd set aside for legal fees in 2015 and all that. But the theme here is that their revenues are on the down low, and they declined something like 13% quarter over quarter. This is the kind of thing that will push, in my forecast of this, we are pushing this genie back into the bottle. Just like you say, we don't need more debt and more consumer financed acquisitions of things. We need less debt and higher levels of savings. The banks are in retreat because they gouged themselves at the expense of everything. They counseled literally corporations, governments, whole nations have been counseled into bankruptcy, from Puerto Rico to Greece, you name it. These bankers have their hands in that pie. And as I say, the sooner we stop taking financial advice from geniuses like this, the better off the world is going to be. And I think they're going to deselect themselves, because when we had the Goldmans of the world as partnerships where they were responsible for managing their own risk, where they had their own capital in there and could lose it if they made bad bets. That is the sobriety that we need to keep people accountable and awake at the wheel. Whenever you have people cashing out, I've said this a million times, when corporations are built by the founders and then sold to the public through the stock market, the founders cash out and everybody else is left with typically a much less valuable entity. The price of the shares, the securities may well go up for a period of time, but ultimately the company is typically run into the dirt, gutted of strength. The people who cash out make a fortune, and everyone else is left diminished in the process. So this whole thing about it was, as I say, it was many steps. It was not one, but it was the allowing of the merger between banking and investment selling, and then it was allowing these partnerships to become banks, and then to have their risk underwritten by the government through the FDIC coverage. That was all part of this cesspool that was our financial system. So we need to, as GE recently did, they took themselves off. They parted themselves with the financial arm because they didn't want to be a dominant financial institution, because there's so much regulation and problems with that. So they wanted to go back to just doing what they did better, which was the core production of products. So I think Goldman and Company, we're going to see them, even if no one has the political clout or will to make this change, I think they will exclude themselves and go back to being separate entities so that they are able to not worry about being fiduciaries, because frankly, they never were, even though they're supposed to be. They wouldn't know the first thing about being a fiduciary. Remember Lloyd Blankfein, when he was being questioned in front of the Congress and in 2008-9 in the midst of the financial crisis, the curious look on that man's face. This is a Harvard-trained lawyer, right, who goes into the banking system, and he's professing to be puzzled by what they mean about fiduciary duty. I mean, this is just a man who took out any ethical training he had as a lawyer and threw it aside when he became the head of that corporation, which is all about money making. It was always about selling your stuff, taking your cash and calling it investments for other people, and no care for the consequences. That's their whole business model.
Yeah. Oh, so true. So true. Hey, but go back to another thing that's wrong here is one thing that Buffett does. He never gives any of his managers stock options in any company. Nothing. They are tied in directly, bonuses, a share of the profits, a very generous share, I might add. His successful managers get very, very wealthy, but only tied to the success of the operations of the company. There's no financial engineering that even though if I could do a 5% increase in profits and it leads to a 35% increase in the stock price, then my stock options become worth 50 times what they were vested for. Then I get very wealthy. None of that. No, I get maybe 10 or 15% of a share of the profits, but no, I don't make anything. I'm divorced from the performance of the stock. And that is a very good thing, because let's go back to Steve Jobs. He never cared about the price of the stock. I'll bet that he seldom ever even looked at the price of Apple. Maybe he watched at it only as a curiosity. I don't think he really cared about it. He never did anything for the shareholders.
Well, it's a completely different business model. I mean, when you're running a business, it is, and it's your own business, you own it. You have every incentive in the world to control your risk, get the debt paid off if possible, so that you have more stability and you have higher cash flow and you have a greater ability to weather storms and you have a higher profit ability because you're not holding all this debt that you're constantly having to pay. So there's every incentive in the world to manage your debt properly when the risk is personal or the risk is a corporation that you own. When you start being incented to make stock prices go up, that's a completely different animal than the health of the company, and you're measured in a completely different way. So it is totally antithetical to managing the core business, and that is the very problem. The corporate structure is supposedly about sharing risk with the shareholders. But when the shareholders become a bunch of faceless, passive people who just want to collect never-ending dividends that are constantly increasing, and they really don't want to see any value the price go down, they want the price to only go up. They're not actually investors. They're actually just people who are sort of going along for the free ride.
They're rentiers, right?
That's it. So this is the deal you make with the devil when you sell your company to the publicly traded markets. You get the cash out, that's all good, but then it's this pretending you're managing the business when really you're just placating shareholders, and you end up making bad decisions. And if you're paid with stock options, you're incented to do things that are probably long-term damaging to the company. The stakeholders just get all skewed on one side, and the duties to employees and customers and sustainability is all thrown out the window.
Absolutely. Well, we've gotten to the fundamental problem of American business and international business, for that matter, because it's all gotten into bad behavior, perverse incentives, and really divorced from the fundamental well-being of the entity and the parties that rely upon that entity for the long haul. And then we get into the quarterly mentality, earnings season, which to me is like just the dog chasing its tail. It doesn't mean anything. You know what it's like, Danielle? It's like you go to the airport and they weigh your luggage, right? And you're 10 pounds over, and they say, well, you can take that 10 pounds and you can carry it on the plane. Now, what the heck is the point of that? Because the plane is still going to have the same weight. It's in the passenger compartment now and not in the luggage. What changed? Well, that's what earnings seasons is about. Whether you get it this quarter, the next, or the next, nothing has changed. Fundamentals are still the same for that company. You just got the earnings this quarter instead of next, and everybody's happy. But you know what? The company is still in the same rotten condition that it would have been otherwise. And that's that perception, is really what you're paying for. You're buying headlines, and you're not really acting in the best interest of the company or the shareholders for the long haul.
No, but also, if you look at this phenomenon, if you look at a chart of the S&P 500 as an example from, say, 1995 to present. Now, we're only talking about, like a 21-year period there. But you have a look at that, you'll see that this is all fairly new, a fairly new mess that's been made. I know that it feels like our history, so it feels like this must be the way it always was or always has been, but it's actually not, right? If you can take the leverage back out of the system, if you can realign management and their goals with all the stakeholders, because ultimately, if you're an investor, you have to have some patience in allowing a business to organically grow and do the right things that for the customers. That's the number one thing. That's who the duty is owed, to build an organic business that's stronger over time, that pays down debt, that builds revenue. Those are all very laudable goals, and they can be accomplished by executives that are incented to do that, to manage the balance sheet, to be compensated based on credit worthiness and their balance sheet rather than just equity appreciation. So we've been through this dark time. All these things we've touched on in this call were all conglomerated together to make this mess, and we can strip it away and put it back to a system that serves the real economy and households and businesses, and doesn't just strip like a strip mine all the value out of everything and turn it into bubblenomics. So, I think we can definitely fix this. I think that your political discourse in the next number of months is going to continue to revisit this issue. And if Trump can bring that forward, then I'm all for that. I think that we'll see who else Hillary puts on the ticket, but we really do have to keep up the pressure here. Whatever political party, because they're all subject to these perverse influences, whatever side of the aisle you're on. And it's because these lines need to be put back on the road. So if the public just continues to insist and not accept a return to business as usual, I think that ultimately this mess will correct itself.
I totally agree with you. And I just make one other observation about Trump. His biggest failures have come when he engaged in publicly traded companies. When he did everything privately, you see how well he's done. And once he got out of the private company, the publicly traded companies, you see how his portfolio's increased.
Now, when he says he's the king of debt, that is, even if he means that personally, that lacks a certain understanding of the plight that is presently afflicting America. If you think you're the king of debt and you're using that as a sales moniker at this point, I think you're missing a few of the small strokes here. Well,
king of debt, when he uses debt to buy an income-producing asset that is going to appreciate an undervalued asset, you got to take that in perspective here. Not taking on debt to, buy flat screen televisions and cars that you can't afford and all that stuff. But in any event, I think it's just an interesting thing that his biggest blunders have come when he, took companies public, acquired publicly traded companies and that type of thing. Anyways, Danielle, hey, interesting conversation. So find Danielle's work over at jugglingdynamite.com. Check out her market commentaries, always enlightening. And hey, we'll talk to you in a couple weeks. I'm off to our neighbor to the north to check out the Sprott Resource Conference that will be taking place in Vancouver. I think it's from the July 26th to the 29th. So, hey, we'll stay in touch. Be well. And, hey, take a look at financialsurvivalnetwork.com. Sign up for the newsletter. I've been lazy for the summer. Haven't been doing it. I have been remiss, but we'll get back into it very shortly. Talk to you in a couple weeks, Danielle. Be well.
Happy travels.
Thanks.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.